Welcome, Ned, to the Connect podcast. Very excited to have you, the podcast where we educate listeners on how to best take control of their financial future. Today we have Ned Hodgman, and we're going to discuss the importance of holistic financial planning. We'll also be discussing protection planning for premature death and long-term care events, two events that can devastate a family financially. And we'll also talk to listeners about how to approach investing as well as retirement. Ned is a US born citizen who lived in Russia during the Soviet period and the reforms of the 1990s. During that time, he founded a manufacturing company and consulted for a major European market research company. After some time in the policy world in DC, he moved into financial services and worked for New York Life and then for Connect Advisors with us. So thank you for being here, Ned. Can you talk a little bit more about your background, some other things that you think people should know?
Sure. Thanks, Andrew. It's nice to be here with you today and talk about these things that I know matter to a lot of people. I was an academic type for a while, but I kept getting pulled into the business world, and I ended up really enjoying the business world a little bit more than the worlds of policy and academe. And so I stuck with it. And when I got into financial services, it was a crash course for me because it was a new world. I'd been in business, but I'd never been in financial services. So I really enjoyed the challenge and got early exposure to the importance of planning and helping people, figure out what are the best tools out there in the financial world. So, some of my life experience has been helpful to me in dealing with different types of clients. And then, mostly it's been sort of the training and just talking to people, what's going on with them financially. You start to see some patterns, you start to see some common kind of behaviors and goals that people have, and then you start piecing it together and helping people, with a strategy.
Gotcha. Great. Well, you had a very successful career at New York Life. What did you learn working at New York Life about protection and insurance?
Well, when I was at New York Life, my main focus was on life insurance. I did do a little bit of work on some investing for people, different types of investments, but mostly it was insurance. And I also did have a couple of death claims when I was working there. So some of the people that I had sold insurance to ended up passing away. And so I saw where life insurance comes into play for people and how important it is. And I also got a sense of the different types of life insurance, why it is such an important decision to make sure that you have some life insurance in place. And, we talk about having the right kind of life insurance, the right amount of life insurance. And I think training at a big life insurance company like New York Life, as some other advisors in our team, you had some experience there as well. It is very helpful because you get a good picture of what a massive industry it is and also how much choice there is in life insurance. So, in our world where we're helping people as fiduciaries to look at lots of different choices, one of them is choosing the right kind of life insurance, the right company, the right product, the right time frame, the right amount, the strategies. And so we kind of have to distill all of that for people. And I guess getting a start in the life insurance industry was helpful in that regard.
Yeah, absolutely. And I feel the same way. And then, so after New York Life, you moved to Connect Advisors, or we were called Securian back then. But what made you decide to go from, purely life insurance and some investments to more holistic financial planning?
It was really a desire to be able to help people more comprehensively. I wanted to be moving beyond just sort of a product oriented conversation with people and really talk about what their financial goals were, whether it's, planning for college for their kids, planning for retirement, getting ready to buy a house, some big event in their lives that's coming up, like a wedding or one of their children's weddings, or some medical issues, lots of different things that can come up in people's lives. And I realized that it would be more interesting to be able to talk to people about their lives and then how that plays out with their money. And I think that's what drew me in.
Yeah, absolutely. Absolutely. So, uh, those are great points there. Um, Now let's move on to investment planning and retirement. What strategies do you think investors should be thinking about in terms of investing? What strategies should people be thinking about in terms of retirement? How do they make their retirements last for the rest of their lives? What are you finding with clients is useful and is resonating with people?
Well, that one of the biggest questions people have is, will my money last in retirement? And, we hear that at Connect Advisors, we hear that from clients who are heading towards retirement, maybe even close to retirement, but also from younger folks who are thinking about their strategy for the long term. Everybody wants to make sure there's a nest egg. Everybody wants that fortress built, in time for retirement. And, one thing is that it is important to start as early as you can. It's good if you can get started on saving towards retirement in your 20s, ideally. Once you start with regular employment, you want to be putting some money aside. The other thing is that your time frame really influences the kinds of investments that you can get into for retirement. So that's why having a financial advisor to talk to can be helpful. There's so much information out there, right? I mean, you go on to the internet and you just start looking around and you ask questions, what's the best retirement strategy for me? Well, certainly you can get a lot of ideas from the internet, but to really look at it in your own particular case, you can ask, AI will give you lots of, ideas about this, right? But when you think about your own particular case, it's good to have a person to talk to. And that's where I think, you know, financial planners come in, is that we're there to have that conversation with people. So helping people really define what they want to do. I find, people are so busy, right? They've got so much going on. They've got kids, they've got work, they've got family obligations, they've got their religious institution if they go to one. They've got all kinds of things that are part of their lives, and they don't often have time to really think about what's going on financially. So, retirement and investing, I mean, I think of those two things are intertwined, of course, and figuring out what your investment strategy should be uh, at whatever age you're at is going to help you with retirement. That's really the key thing. So if you're closer to retirement, you should have an investment strategy that focuses on keeping your money safe, right? If you're kind of middle aged, maybe in your 40s or 50s, you still have some time for your money to grow, but you want to be looking at a time when you should be scaling back on those aggressive investments so that your money is a little safer. And if you're in your 20s or 30s, you should really be aiming for the fences, swinging for the fences. You should be investing aggressively, except for a portion of your portfolio. But most of your portfolio should be aggressively positioned so that you really can get the growth that the US economy can generate, which is pretty amazing. Have to, knock wood when we say that. Let's hope everything works out, right? Because we're never sure what's going to happen tomorrow in America. But we also see that historically, the trend lines have been very positive for people who invest their money and stay in the market.
Absolutely, yeah. Yeah, stock market has done phenomenal for a lot of people. Let's turn to something that a lot of people don't really think about in retirement, which is long-term care. People don't plan for that, and what happens is they build up this sizable nest egg, and they go into these expensive nursing homes, and what happens is it completely whittles their investments completely, and
Hmm.
they have nothing
Hmm.
to leave for their kids, and so can you talk a little bit about that? Because I know that's something that you,
Sure.
I would say, have a very good specialty on.
Thanks. Yeah, well, you and I have talked about this, including with some of our clients, and looked at this in people's lives. And I've experienced it in my own life. as of some other advisors in our team. And I really try to listen when I hear about situations that people are dealing with, where a loved one, you know, usually it's somebody who's elderly, quite elderly, but not always, is experiencing a health situation that requires them to have help at home, to have help with what we call the activities of daily living. Basically feeding yourself, dressing yourself, moving around on your own, being able to use the bathroom on your own, mental acuity, all of these things which can fade fairly suddenly in people's lives if they encounter an illness or a an accident that leads to that condition. Excuse me.
Bless you.
Uh, yeah, that'll make good video right there. So, uh, but there are tools out there that can help in that pretty unpredictable situation.
Yeah.
So long-term care insurance, all of these terms really, in my opinion, are they're the sort of thing that it can help kind of make you freeze up if you're a person looking at this from the outside. Now, you and I and our colleagues and a lot of good financial advisors out there in the world, have really made an effort to understand these things and be able to explain them competently. And really that's a big part of our job, is just to be able to explain stuff to people so that they can understand how it works and get a little more confidence in the institutions that provide these products. Long-term care insurance is I think a particularly kind of a difficult one for people to engage with emotionally, right? Because we don't want to think about we don't want to think about what's going to happen to our health. We don't want to think about getting old. We don't want to think about, what would happen if I had to have somebody take care of me. Most people think A, they're going to live forever, B, they're going to be healthy forever, and C, I don't want to hear about anything bad happening, right? That's just kind of the frame of mind. Not everybody. Some people are very forthright about these issues and approach them, in a very direct way. Tell me what I need, tell me how much it's going to cost, tell me how it works, right? But for most people, it's it's an emotional hurdle to get into this conversation. So your advisor should be helping you understand what the tools are. That helps you get over that emotional hurdle. And really see long-term care insurance as one example. See it as a tool that's going to help you in your life rather than as some arcane, hard to understand financial product. That's really the transition. So, but there's a lot to talk about in terms of long-term care insurance. What do you think your viewers would be most interested in, or what should we kind of start with in that area?
I think just like strategies that, we see people implementing, or, the different kinds of long-term care as well. It's
Mhm.
it's a pretty big topic, so it can be daunting, like you're talking about. Whatever you think
Well, I'll,
would
I'll
be
pick
good.
up on one of the things that you mentioned when you were just going over this topic, which is that people save a lot of money for retirement. They're thinking about retirement, but when they hit a long-term care insurance situation, as you mentioned, well, so they got to find the money somewhere, right? So the money's going to come from those retirement savings, and that is where problems can crop up, because if you encounter a health situation where you need assistance, right? That's really what long-term care insurance is. It's not medical insurance, right? It's not hospital insurance. It's the insurance that pays for people to come to your home and help you out if you need help. Uh, Even it might be somebody that you pay in the neighborhood or your niece or nephew who comes to help out, but that kind of care, all the way up to skilled nursing in a facility. That's a word that nobody really likes to hear, but in other words, in a professional setting where you get professional nursing services. Uh, so the problem is that that kind of care is very expensive. And if you understand that having even informal care in your home is going to be, I'll be really generous and say maybe $20 to $30 an hour. It's really moving towards right now in 2024, it's really more like $25 to $35 an hour for that kind of care in most major metropolitan areas of the United States. So, I mean, just think about that. So 8 hours of that per day, you're at $250 a day. Multiply that times seven, you got $1,700 and $1,750 going out. Multiply that times four, you got almost $8,000 going out the door. Close, 7,000, right? So you know that's just for 8 hours of care a day. Sometimes people need more. So it gets so expensive that then people have to raid their retirement savings. And that is really, so that's just, okay. So I'm doing the sort of the scariest scenarios right now, but they're real life scenarios.
Yeah.
That the one I just mentioned is kind of a basic scenario where you need money to help pay for that care. But what happens if you have a nice pot of money that you saved up over time and you are getting ready to retire? And then you unfortunately have a healthcare event where you need to take the money out. And at that time, the market goes down significantly. Like we have a 2008, 2009 event, and we're seeing a 50% drop in the S&P 500. Well, that means that not only has the amount of money you have available for regular income to help you in retirement gone down a lot, but the money, you have to take money from that pot to pay for for the health care that you need, the long-term care. So then that amount, that nest egg is getting smaller even faster. So once you realize that possible scenario, that's when it becomes time to look at long-term care insurance and kind of understand what the different types of long-term care insurance are and what would work for you.
Absolutely, yeah, and we're talking about long-term care here, and how do people fund that? So there's a couple different ways. There's the traditional long-term care that's sort of fallen out of favor recently, um, because it is the model of you use it or lose it. And the issue with that is, if someone doesn't use it, well, they want their money back. So can you talk about how the industry is kind of adapting and what the sort of ways a person can fund this?
Sure. Yeah. And you gave it a nice overview there. It is, the industry has had to shift from what it was like 30 and 40 years ago because more people need long-term care insurance because we have an aging population. And so, but at the same time, people, as you mentioned, don't want to just pay into something that they're not sure they're going to have to use. So the generally accepted statistic is that 70% of people who have a long-term care insurance policy are going to end up using it sometime in their life. They may use it for many years, they might use it for a few months, they might use it for, 6 to 8 months, something like that, or they might use it for the rest of their lives. So being ready for that eventuality is really important. Uh, Now, how do you fund it? Well, you mentioned traditional long-term care. So the companies had to adjust from that scenario where you just paid in the way you would pay for, your car insurance or your life insurance. You pay every month. You don't know if you're going to have a claim. And then you have a perfect driving record at the end of 30 years or something. You never had an accident. You've been paying for the insurance all that time. All that money is essentially gone. When it came to long-term care insurance, people said, well, this is also part of my retirement. So maybe I should get this money back if I don't use it. And that's when big insurance companies, in particular mutual insurance companies, uh, started to build these policies they're called hybrid policies. And so hybrid, as people can see when they do a search online for what's out there in terms of long-term care, you can get some basic overviews, but it basically means it's a combination of life insurance and long-term care insurance. And it's a very good type of product to consider when you're thinking about these needs because you have a pot of money that's in life insurance, and it can be different types of life insurance. But just think about it. Let's just say there's $100,000, right? $100,000 life insurance policy. Ideally, it should be growing a little bit every year, right? The amount that's in there, so that pot of money is growing. If you and you sign up for that and you pay for that. How you pay for it, we can talk about it in a minute. But the basic idea is that's growing in the background. If you end up needing long-term care, you need to have people come and help you out with things at home, or you end up skilled nursing or whatever it is, any part of that spectrum, you draw from that life insurance benefit. You draw from that $100,000 plus amount that's been growing for you. Now, you might use some of it for long-term care to pay the caregivers, to pay for remodeling your house a little bit, maybe putting in one of those, to help you out with a ramp or something like that if you need to use a wheelchair, different things that you can pay for with it. And then, you still have some money left in the life insurance policy. So at the end of your life, if you haven't used up the whole life insurance policy, that money would go to your loved ones as a death benefit. So immediately that changed the whole market for this product because people really started to look at, well, what what's the best option for me if I'm going to get a hybrid policy? And then it kind of grew from there into different approaches for hybrid life insurance. So they have, you know, ones that are based in the market, where you have a market investment that's helping your investment grow. You can have a whole life insurance policy helping your investment grow. You can use an annuity, and there are a lot of different angles and different approaches within those choices, I would say.
Yeah, absolutely. There's a lot of good options out there for long-term care insurance that can, be flexible and to a client's budget to help them mitigate this, right? Because I mean, the whole thought around this is, take a small take a small part of your retirement and use that to protect the rest of it from a disastrous long-term care event. That's really what clients are trying to do.
Mhm.
So,
Mhm.
uh, yeah, there's a
No,
lot of
thanks.
great solutions out there
Yeah.
that the market has created. So, yeah, that's great. So we've discussed the importance of financial planning, the importance of protection planning, planning for, life insurance, premature death, and long-term care events. And we'd also talked about investing in retirement. Any other closing thoughts that you have, Ned?
Well, you mentioned financial planning, and I think that that is a key topic that people don't think about probably enough or as much as they should. It can be a pretty affordable way to get a wingman, essentially, a coach, a navigator, somebody who's working with you to help you figure stuff out financially. So our firm focuses on comprehensive financial planning, and quite a few of our advisors provide that service, which is it's a full menu of financial services that we can provide and give advice on as fiduciaries. So of course, you have to be licensed to do this. You have to be trained to do it. But ideally, having a comprehensive financial planner working with you, it's a way to prepare for all the other things that you and I have talked about today. So, because you're going to talk about investing, right? You're going to talk about investment strategies. You're going to talk about individual investments like alternative investments, right? One of the things that we're working hard on to educate people on. You're also going to talk about the insurance picture, right? The retirement planning picture, health insurance, college funding. All of those things can come up as part of a comprehensive financial planning relationship and that's what many of our advisors have with their clients. So I do think that that is one thing I would, for folks out there who are thinking about how best to tackle their financial problems, think about working with a comprehensive financial planner, financial advisor who is trained to look at all aspects of your financial life and build that relationship. It's a commitment from both sides, and but it is a great way to really learn about what's going on in the market, learning about the different products, get some choices as you look at these different issues in your life, get some different choices, get a menu of options so that you don't feel like you've been channeled into one particular product or one particular strategy. So that's
Yeah,
something I would definitely stress.
absolutely. Yeah. And you mentioned alternative investments as well. Can you talk briefly about the importance of alternatives and why clients should consider having them in their portfolio compared to just uh, a stock and bond portfolio and any other things they should be thinking about as
Sure,
well?
sure. Yeah, well, you asked me to talk briefly, and that's going to be the biggest challenge, but I'll do my best.
Take your
So,
time. Take
yeah,
your time.
yeah, in terms of alternatives, well, yeah, let me start with you mentioned sort of what are some general principles for investing. So we talk about asset allocation. These are some terms that people might have run into. Being diversified, of course. We talk about asset location. That means being in different institutions, not having all your money with one company, one investment manager, or one insurance company. Try to have it be spread out among institutions. That makes it safer. Growth, guarantees, liquidity, these are all the terms that come to mind. And as one of our colleagues at Connect always makes the point that if you want guarantees, you're going to get a little bit less liquidity. Uh, if you want more liquidity, you often might be facing more risk. There's a bunch of different factors that come into play. But one of the ways that you can protect against market fluctuations is by having a portion of your investments in what are called alternative investments. It's not a perfect word for that sector of investing because these are not sort of exotic investments. These are major financial tools that constitute a huge part of the US economy and that have been used by, municipalities, university, college endowments, big corporations, for their long-term investment strategies. They've been using them for decades. But these investments have only recently become available to the retail investor. And it's the job of a comprehensive financial planner to explain to you how these work and then see what portion of your portfolio could go into alternative investments. So, what are these things in particular? What are some examples? Well, it could be a real estate investment trust, one example, a REIT. So, the word REIT gets tossed around a lot. Real estate investment trusts can be in lots of different kinds of real estate, right? They can be in corporate office parks, they can be in strip malls, they can be in storage facilities, they can be in residential housing, just a whole range of things. What a REIT needs to do is to deliver on the investment because the people who run it have chosen good real estate projects that are going to return a nice return. And sometimes the return is very good. Sometimes REITs even outpace the S&P 500. So, but other examples, you could look at the corporate debt markets, and you can that's a massive market, and you can get into products that provide a contractual rate of distribution. So that means that you sign on and you basically get into one stage of this of a project where the company is lending out money to big companies like you know uh, Boeing or Walmart or some big retailer. And those companies need to use money. They need to borrow money in order to grow or do new construction projects. Well, they need to secure those loans with inventory or property or capital in order to get a better rate. You can buy into those secured loans and get a piece of the return from those secured loans. That's a great example of an alternative investment that is not some, fly by night, flash in the pan type of thing. This is done every single day by Fortune 500 companies and smaller companies to borrow money so they can grow. And as individual investors, Americans can get into those. And it doesn't mean you have to invest $100,000. You can invest $1,000 in some of these products. Another example is structured notes. So structured products. And structured products are another thing that we at Connect are able to talk to our clients about. We think that they could play a very important role. Consider this: with a structured note, you can get a very nice return, a return that is likely to beat a CD, sometimes even significantly beat a CD. And the only thing that you don't know in certain cases is exactly how long it will take for you to get your money back. Could take a year, could take a couple of years, but you're going to get increased interest every quarter that you invest in a product like that. At the end of 5 years, if you wait all 5 years, you're going to get 5 years of a very high interest rate. So there's some risk of having to wait a little bit longer, but you also get a very nice return. So that's the structured note. And that's a very, you know, there's a lot of detail there, but the basic idea is it's a promise to pay. There is some risk involved. You can lose money in those products. So you want to look at them very carefully, and you want your advisor to explain exactly how it works and when you can expect to get paid. How might you not get paid if that were part of the how it's structured? And then you can go very conservative, and you can even get FDIC guarantees on some of your structured notes. Go from that to more aggressive and a little bit more risk, but it's a very interesting area. So definitely those different areas of alternative investments are, I think, important for our clients, and I think it's good for people to know a little bit more about them.
Yeah, absolutely. Structure notes are definitely an interesting one, the way that you can trade off liquidity for more return and maybe potentially less risk. Another thing that's another product that's kind of similar to would be an annuity. Now, I
Mhm.
know annuities are, a lot of people love annuities, a lot of people hate them. Where do you believe that annuities are important for investors? Should everyone have an annuity? Should no one have an annuity? Or he's somewhere in between?
Yeah, it's got to be one of the only products I can think of, except for maybe penny stocks, that has a bad reputation that it can't quite shake because of the word associated with it, which is kind of crazy because annuities are issued by these massive companies, right? So if you take a company like New York Life or Northwestern Mutual or Guardian or Mass Mutual, Penn Mutual, all these companies are very, very large companies, and they can issue annuities, uh, and they basically are making a promise to pay. Okay, well, who's better at making a promise to pay than a well-established life insurance company? They've gotten very good at paying people, paying their families when there's a death benefit. So annuities are a little different, and they are so varied. There are so many different flavors of annuities these days that it's really not. It isn't appropriate that it gets stuck with this sort of sometimes gets stuck with a reputation of being, oh, no, no, stay away from it. Well, what are you staying away from? There are so many different ways to do this. So, yeah, I think annuities can play an important role in people's portfolios. What's interesting is we have this traditional idea that an annuity is something that you sort of give your money to the insurance company and then you never see it again. Maybe they pay you every year, but you never see the lump sum again. It's just not true anymore. And probably it's not even something that people think about too much anymore, that old flavor of annuity, because the new ones have been around for a while now. But basically, as you know, you can have access to your money. You can get all your money back, or very large, significant amount of your money back from an annuity. There are some costs involved, like with any product, right? So sometimes you can't get a full refund, but you can get a very significant refund. But putting the refund aside, you can get very significant growth, and you can get some things built into the annuity that make it different from a market annuity, a market investment, different from buying a stock, because you can get the floor guaranteed. You can get a guaranteed 0% loss. Like you'll never lose money in this thing. Uh, and then you can get a rate of gain that can also be guaranteed. So, for example, you might have a situation where you have zero loss, and the insurance company says, "Well, we're going to cap your growth at 10%." Let's say that you're invested in the S&P 500 index, and that index goes up more than 10% in a given year. Well, you get 10%. So you're not going to get 15 if the index goes up 15, but you're still going to get 10, which is a nice return. And you get rewarded in a way from protecting on the downside. So if your investment goes down, if the S&P 500 goes down that year, you don't lose any money. You're like, oh, thank God, I didn't lose any money that year, right? Whereas, everybody who was invested in the market strictly, they did lose money. So that's where annuities can provide some of those protections and some of the growth as well. And some of them have no caps, right? Some of them you can get the full growth of the S&P 500 or the other indexes that they have available. So it's a very versatile type of product. And I think no one, and in our view, I think you would agree with this in our team, you don't want to say no to anything until you have fully investigated it, right? really look at this thing, and that's what your advisor should be doing for you, is helping you really understand how an annuity works or how a given investment works. Even if it's just a mutual fund or an ETF, you deserve to know how it works and what you can expect in terms of a return. So to come back around to your question, I definitely think annuities should be part of that whole conversation.
Absolutely, yeah. And you talked a lot about accumulation annuities. Growing a pot of money is one great objective of annuities, is that safe growth over a long period of time. Are you also a proponent of lifetime annuities? What role do, a lifetime stream of income have in retirement?
Yeah, without any doubt, lifetime income from should be a part of most people's retirement strategies. And this has been worked on by a lot of academic experts over the years who have looked at the fact that you're getting a cash payout from an insurance company that's coming to you every month can be a very big part of the overall growth of your portfolio, your overall financial health in retirement. So you want to have your money in the market. You want to have a good portion of your money in the market. But if some of your money is returning a regular income stream to you every month, that's stability, that's confidence in tomorrow. That's sleep at night money. And our strategy that we work with at Connect Advisors is called advanced time segmentation. And advanced time segmentation is built around the idea that lifetime income, as well as other types of income, plus solid, a good investment policy or strategy should be part of your whole retirement. So you want to have income streams, including from lifetime income products that life insurance companies provide. And they are like a supplement to the basic strategy of investing your nest egg, right? So you get some income and you get some growth. That's the basic description, I guess I would say.
Yeah, absolutely. Yeah. Advanced time segmentation is definitely very important. It gives you that short-term money to make sure that you can feed your family today, gives you that balanced bucket to make sure that you can also fund the long term. The third bucket is kind of that middle ground, so that you can make sure that you have money that lasts for the rest of your life. You have money to give to your beneficiaries. You have some alternatives in there that we discussed to make sure to reduce some volatility potentially on your overall portfolio. And yeah, those are some of the plans that we come up with for our clients. And that kind of brings me back to, you know, financial planning, and being a financial advisor and creating these plans for clients. And last question to you, Ned, is what should investors be thinking about when considering a financial advisor? I know you touched on some points, but in closing, what would you say um, people should be thinking about?
So I think the most important thing is communication. There are a lot of tools out there that you can be exposed to. You want to have an advisor who can explain things well, help you understand them, and communicate regularly with you about what's going on with your finances. You want follow through. You want regular meetings with a financial advisor. You want to make sure that that person is keeping track of your investments, and you can check in with them, they check in with you. You want that regular contact. And that's what having a financial planning relationship or engagement makes possible. So I think that, people should really, it's about an individual relationship, it's about a good fit. So you definitely want to talk to a few different advisors from a few different companies in order to see if their approach fits what you're looking for. It should be comfortable. Conversation should be comfortable. The job of a financial advisor is to reduce stress when it comes to financial decisions, and that is done through good communication. So when you talk to a few people from different companies, you'll get a sense of who are the people, who's the advisor who really kind of speaks your language and can help you grow your money and accomplish your goals. It's good to make sure to check and look at a few before you make a choice.
Absolutely. Okay. Well, thank you very much. I think this was very helpful. and I'm sure a lot of people will find it
Thanks.
useful. So thanks for being on.
Thanks. Thanks. Good talking to you, Andrew.
You too. Take care.